We start with the troubled global banking sector.
There are growing concerns over a banking crisis.
The global financial system and the banking breakdown.
Between the struggling banking giant Credit Suisse.
There's been a collapse in the banking industry of late. Specifically, bank run issues at Silicon Valley Bank have triggered a review of the entire banking industry worldwide. The phenomenon is monumentous, so much so that some even compare it to the 2008 financial crisis. One notable case from this scenario is the 166-year-old bank, Credit Suisse. Welcome to another episode of Do Academy. Today we will investigate the demise of Credit Suisse, the second largest bank in Switzerland. Once a pride of Switzerland, Credit Suisse is among a group of 30 banks worldwide known to be systematically important. This is why a full collapse might affect the global financial system. So, when Credit Suisse fell to its knees, its rival and Switzerland's largest bank, Union Bank of Switzerland, UBS, quickly came to the rescue by acquiring Credit Suisse for approximately $3.3 billion. On top of that, Swiss National Bank also offered substantial liquidity assistance to prevent any potential catastrophes. Switzerland was then able to maintain its reputation as a stable financial center. While Credit Suisse is currently in a better position with the help of others, the bank has always been a ticking time bomb waiting to go off. Let us dive deeper into the years of mismanagement, greed, and fraud at the bank. In 2008, Credit Suisse faced allegations when a group of traders were suspended for mismarking some of its structured credit facilities to the tune of $2.85 billion, mostly related to centralized debt obligation, CDO, and mortgage-backed securities, MBS. The reason? So, losses are reduced while keeping the traders' bonuses up. As Robert Kazami, the head of enforcement at the Securities and Exchange Commission, who brought civil actions against these former Credit Suisse traders, have said, the stunning scale of the illegal mismarking in this case was surpassed only by the greed of the senior bankers behind the scheme. The revelations have been embarrassing for Credit Suisse, which saw its net income being slashed by $1 billion, sending its shares tumbling down. The then CEO of Credit Suisse, Thomas Gottstein, vowed the bank would start the year 2021 with a clean slate after spying scandals and embarrassing fallout from compliance and lending failures. However, disaster struck again just as quickly. In the beginning of March 2021, another scandal emerged. Credit Suisse's reputation as an asset manager was heavily jeopardized following the collapse of the supply chain finance firm, Greensill Capital, largely due to its own inadequacy to identify, limit and monitor risks linked to Greensill's supply chain funds. The fund's purpose was to help companies and the public sector to speed up payments of bills and wages, from loaning money to companies by buying up their invoices up front. At the peak of the crisis, Credit Suisse had $10 billion trapped in Greensill, all of which plowed from its wealthy clients, who were made to believe that the fund is low risk from its client documentations. This incident has exposed the bank's serious deficiencies in its organizational structure and its slow response to Greensill's excessive exposure to the steel and commodities tycoon Sanjeev Gupta's GFG alliance, which heavily relies on loans from the fund to stay operational. The world is not foreign to massive financial failures throughout history, but one that stood out in recent years is the collapse of Archegos Capital Management in March 2021. Its founder Bill Huang lost a spectacular $20 billion in 2 days. Credit Suisse, again, is involved in this implosion. Archegos investments never showed up in regulatory filings, as Huang used swaps, a type of derivative that gives investors exposure to an underlying asset without owning it directly. Due to the specific nature of swaps, Archegos investments were concealed from the financial firms that financed them, including Credit Suisse. Eventually, these financiers were unknowingly exposed to the massive underlying risk. Before the debacle, Credit Suisse had more than $20 billion of investments exposure that is connected to Archegos, equivalent to half of the bank's equity cushion against potential losses. On March 26, 2021, when investors globally finally discovered this massive overleveraging by Archegos, the firm built a massive portfolio of $100 billion by utilizing loans and 5 times leverage, where it eventually defaulted. Huang essentially pushed his investment vehicle, Archegos Capital, to its breaking point. The collapse of Archegos Capital eventually left a trail of destruction, causing losses to many of its lenders. Credit Suisse, in particular, faced colossal losses to the tune of $5.5 billion US. All these are just the tip of the iceberg. Credit Suisse has been involved in many more scandals, for instance, Mozambique loans, Swiss secrets, Bermuda trials, Bulgarian cocaine network, and the list goes on. So, what can we learn from the issues that plagued Credit Suisse? As famous comedian Charlie Chaplin said,
"Greed has poisoned men's souls, has barricaded the world with hate, has goose-stepped us into misery and bloodshed."
Most of the incidents mentioned were done intentionally by a few senior banking executives, causing massive losses and distress to their investors who trusted them dearly. No matter the fund size one is managing, it is important to control the notions of greed within oneself, as it can cause you to ignore the red flags and risks involved. Investing in any asset requires intensive due diligence. Investigate facts, financial records, and more. One of the major ways banks make its profit is from its net interest margin, NIM, but no matter how much is the NIM, banks face the risk of default from its borrowers. Hence, giving out loans are the bank's form of investing, and as with all investments, risks are involved. This is why borrowers usually have credit scores and banks do thorough background checks to make sure the money they lend can be returned. However, as in the case of Archegos Capital, Credit Suisse gave out massive loans, even though they're blinded by the facts that Archegos has been using massive leverage, which is extremely risky. Credit Suisse has been an integral part of the Switzerland economy and its history, but it was the combination of years of misconduct and mistrust that forced it into a deal that nobody wants. What do you think about the situation at hand? Be sure to like, share, and follow Do Academy for more actionable investment insights.